Welcome to FOMC trading live session. We have the statement in a couple of 9 minutes. And what's important to note for today's session is if the Fed going to do what they have told us that they are going to, which is, well, at least look at the data. The data tells us that we have slowed inflation, that dollar should probably peak now. And the question that comes to mind, do they agree that we're going to have 4 or 5 rate hikes this coming year? And today is the first attempt in that little direction. So currently I have pulled up the dollar index. We are going to see a reaction there first, and then we are going to see a reaction after um, the press conference. So, is there anything out there? Is there any currency pairs you want me to cover? Is there anything I am planning? If we get, I'm planning to buy euro dollar. If we, oh, sorry, not euro dollar, Australian dollar, US dollar, or New Zealand dollar, or whoever I can get quickest on. Not euro because ECB is tomorrow, and I think it's going to be bearish for that one. So what are we going to do for the last day of volatility this year? Last year of volatility, we shall see if we are able to do something about that. Cool. Okay, so that it just depends on, are we are we able to Jesus, can I talk about British pound, New Zealand dollar? Not at the moment. I can probably do that later. It is not at the moment in my vocabulary. And to be honest with you, it is not in a very great place in terms of seasonality. So it's a bit of yeah, it's a range as well. So I wish you look at other pairs that actually has a good fundamental reason behind it or something to that effect. So we have USD yen, which actually did come back up here. So there is your sell if you wanted to have that, or coming back up to this price. I didn't sell it, but that's because I don't trade it actively. So if we get bearish dollar, we're gonna have dollar yen falling. If we get a bearish dollar, we're gonna get New Zealand and Australian dollar higher. I am not going to trade euro because we have ECB tomorrow. We have Bank of England also tomorrow. Ivan, do you really believe that inflation is getting lower in America? Okay, that is a very easy, straightforward question, sir. And let me see if I can find that quicker than anything. Indicators, inflation rate, America, not Africa. So if you go to America, has inflation come down? Or is it coming down? Will it come down? Well, it's clearly going down. Is it enough? I have said in various meetings today, the market have put itself in a very small position where they have painted themselves into a corner for them. So they are making it like 90% chance for dollar bullishness, either because of they have priced in so much rate cuts. Two, inflation hasn't come down as much as we wanted to or needed to. We are at 3.1. We were 3.2 last time. So the data tells us we have come down. We are coming down. I mean, people are seeing prices going higher on the supermarkets. Okay, that then you have to go into look into what makes up CPI, US CPI, and when you go to the Bureau of Labor Statistics, and you look at the latest CPI number, and you look at what made the CPI rise, it was shelter. It's not food prices. Um, and gasoline index is pushing it lower. So, and I think food was, yeah, slightly higher. Not as much as in October. So, yeah, prices in the store goes higher, but across the board, not as much as it feels like. So when you have 5% inflation, you're gonna have some items that goes up 50 or stuff like that. So it's not, uh, not this one, but yeah, other things that excludes food and energy, but the price driver of inflation is shelter, not food. So, but then there is more to the story that is sending things lower, such as, well, you can take away oil prices, fat matter, but it's still very embedded into, for example, transportation services. It is very embedded into storage, into yeah, so warehouse, into every business that is needs to transport their people by car, by air. Um, they still need to pay for heating, like oil and electricity. Is very embedded into society. So just because they exclude it doesn't mean that they're excluding it completely. So that's just that. Right. Hello, Abbas. Long time never see. Hello, Joe. Boom. So, Dexter, do you really believe inflation is getting lower? Yes, I do believe so, because it is the only measure I have. CPI lower. Was it PPI today that was lower? Um, and how else are we going to measure inflation? Well, I don't know how else I can measure inflation other than rely on what the government tells you, no matter how you want to flip and flop it, no matter how much they are trustworthy or not. It is the metric we have, and then we can say, okay, do we believe in that metric? Do we not believe in the metric? Um, question mark. Okay, cool. There we go. I'm trying to find Federal Reserve on a different screen. Let's say it is less than a minute now. I have that one open. Okay, cool. I'm just going to use the euro dollar there. Good luck, people. Boom. Trading forex is risky, by the way. Projection interest rate 1 year is 4.6. Second year 4.6 and 3.6. That is immediately sending euro higher. And 5.4 in the current year. All right. Joe, can you help me? Is that higher or lower than expected? Then we have the PDF of today. Let's see what they say. Say, is that minutes? It's the wrong one. It's the wrong one. It's the wrong one. Or is it? Do you have a better site than I have? Than the government themselves? Euro is currently going higher. Dollar yen is currently going lower. I need to find out why the dot plot. Rate decision was 5.5 as expected. It needs to be that the dot plot is either lower than expected or as expected. Oh, this is fun. Why can't... There it is. Okay, fair enough. Press release. Recent indicators suggest that growth in economy activity has slowed from a strong pace in third quarter. Bangers, boom. Job gains have been moderate since early in the year, but remain strong. Boom. Unemployment rate has remained low. Boom. Inflation has eased over the past year, but remained elevated. Boom, boom, boom. This is what I wanted to see. Yes, they are acknowledging that inflation is coming lower. They are seeing what I need to see. They're seeing the same thing as I see. I'm not blind. I'm reading as fast as I can. Maybe I should have a bot doing this, by the way. FOMC median 2024 growth projection is 1.4 versus 1.5. Their projections are lower. The FOMC rate forecast shows a wide range of projections for 2024. Inflation has eased over the past year, but remains elevated. The median forecast shows 75 basis point rate cuts for 2024. That is for three-year rate cuts. The market priced in 4 or 5, and they see 4.6 by the end of the year. That is an interest rate by 4.6, currently at 5.5. It is great news, everyone. Great news. One news bump and then dump and then pump. Yeah, fair enough. Man, this is great. Why not? Why not, people? Why not? So, Christmas comes early this year. This is what happens when you get 2 news in a row. Yeah. And earlier today we had PPI that was a bit mute, of course. But it is showing year-over-year 0.9, 2% X food and energy. Everything is great. Everything is great. The median view for the Fed funds rate at the end of 25 is 3.6 versus 3.9 previously. And I hate that this one doesn't show it, but it is where it is. Oh, no, it does show, by the way. I'm just blind. I do apologize for being blind. Cool. This is great. This is great. Okay, cool. All right, people. What next? What next? Gold looks like nice above 19, 119.97. Let's go into dollar yen that was requested by our lovely Crystal. Dollar yen is currently falling. Yen pairs are actually falling, which wouldn't be a surprise to me, actually. I'll see yen going higher, maybe. CAD yen going a bit lower. Pound yen going lower. New Zealand muted. Australian dollar. I missed you, and I missed you for some reason. My absolute apologies to my trading encounter about that. But coolio. Should we wait for the pullback on the Australian dollar, New Zealand dollar? That would be great. Let's go over to the 1 minute. I need to see pullback. And we'll see how deep we get it as we continue going forward. I wish you a Merry Christmas. I wish you a Merry Christmas. Okay. So I see gold to go higher. This is what I wanted to see or needed to see. And we shall see if this one do continue higher or if it comes a bit down before it continues up. When gold starts going, it does go very quickly. U.S. interest rate futures raises odds for a May cut to 90%, which was 80 before the meeting, which you can see that one. Go over here. That is now 9. That was December, sorry. Now, okay, that's been updated yet, by the way. Sorry. It is 49.4. I need to make sure that I do look at that one for two times. Okay, my Federal Tool is not updated yet. Hi, Carlos. You're back. When is the best time to enter the market after this news? I think that it is. When is it best time? Also, your plan is, if your plan was to trade the news is gone. Then, as I'm waiting for a pullback of some sort. So, if I can get a quite deep pullback, I just don't want a 100% pullback. But if I can get like a 50, 38 pullback, then I'm pretty okay with it. So it's still waiting for it. Still waiting for it. Just needed to come back down. So what my strategy here is, I need a pullback to buy New Zealand dollar and Australian dollar, US dollar. Euro can go and take a bun. I'm not going to trade that one. And pound dollar had a move of 70 pips. Great. So we have been given what the market wanted. So in my view, we have been given what we need. We are in line. Now the big question, I'm going to talk about this. The big question is going to be Fed. Is he going to talk about rate cuts? Is he saying that market or that they find their current rate level to be appropriate? If he does do so, I can guarantee you that dollar's going to fall. Hi, Kasasa. Alrighty, I've been fighting people on investing.com. I are completely banned from there. All right. Cool. So let me go back to how you're supposed to trade this one. Now, the thing is, should we can I scalp one here? New Zealand, can I scalp it? The thing is, if this 23.6 only pullback, okay, all right, okay. Where are we now in my brain? So going forward, there's going to be seasonality bullishness on Australian dollar, US dollar, going from 22nd, I think, 18th, 22nd. So that was just unlocked now, to be given a start. The only question now is, are we going to if I can find this one for you. So 21st, 19th, yeah. This little dip here, 80% winning chance. Most years positive, around 100, 200 pips, give or take. And fair enough, nothing too bad. Standard deviation is almost 1%, so it's quite good, quite high, quite great. So going forward on that, that's the other reason why I would like to buy it. But the only question is, are we going to get a pullback that I want to see? And I'm not seeing a pullback right now that I am extremely interested in. I might go back to swing trade it, and I know it's a range, so it doesn't matter. Okay, cool. So charts, people, give me charts, and then we will discuss it. Which charts are we going to go through now? Nasdaq going higher, S&P even better, dollar falling like a ton of bricks, which is great. And I saw Nick made a video about unregulated brokers being kicked out of MT4. Just making that sense as well. Okay, Nasdaq. For me, this has been, a trade for a long time. We did get some kind of pullback here. It is a range, and if you say that's a higher low, there you go. There's a higher high again. I believe that this should have been the peak and then falling down because it's FOMC. So to be honest with you, as long as it's above 1640, you're good to go higher. But what am I talking about here? I am talking about a continuation trade, a trend trade, given that by Monday you haven't hit any weekly targets. Let's see if we can find that one first. A weekly target would be great, or which you have already hit. Monthly target. Hope you haven't hit that one either. Then you can continue. Fair enough. You have still a monthly target to catch. So, what do I do what here? Okay, cool. So, what's the deal here? Higher high, higher low. Though we normally see deeper pullbacks after or bearish trend after FOMC meetings. So if we can get this as a high and then we pull back, I'm just going to point out when was the last FOMC meeting. The last FOMC meeting was it 25th, 26th, Tuesday, Wednesday, somewhere around here. And then we had been falling already, by the way. But it doesn't this isn't the move higher. This isn't the catalyst higher. This is more like the exhaustion of it. But fair enough. It's too high for me to look into buying it right now. It has ran away. Is this the catalyst that the market needed to go full bullish on stock market? Yes. Yes. And I think we're going to be about 4,700 by the end of the day. By the end of the week, sorry. On A, I'm looking for a pullback to 66. I think that's a bit too deep, to be honest. Well, no, it's all right. That's okay. That's okay, Crystal. That's all right. And US 30. Dow. I don't know how pound yen came in there, though. Yeah. Another mover higher. Fantastic. Congratulations for those who bought in on the seasonality start around October. Sorry. And market is now up from October around 10%. Congratulations very much. What's your intro trigger, lol? Okay. I can tell you. I need. Depends if I'm scalping or not. But up here, I need deeper pullbacks. And then once it come down here, I want to see a reversal of trend on a smaller time frame. So I'm not trading the US 30 today anyways. Euro dollar, I wanted to come back down like to a support. Or for that matter here as well. Oh, nah. I measure the first hour, first minute candle, and then I want price to come back down to 618 or 50% retracement. Then that's a limit order. Yeah, yeah, yeah. Also for stock market, yeah. That's stock market is long term. That's not scalping. I don't scalp it. It's two different things. Depends what you ask about, to be honest. That's funny. So you have ECB tomorrow. You have Bank of England tomorrow. You are definitely going to say they doing the same thing. So are you ready for that roller coaster? And the problem in that is, where do you find the strength? Where do you find strength? Because you need to try something strong and something weak. So to be honest with you, really, I didn't plan for this one to happen. 72 pips higher. This was not how my live trading was supposed to go. My rules are too strict. What is going on? We're making higher highs and higher lows. What I believe is going to happen in Euro today, by the way, now that we're stronger, higher, that they're going to price in whatever today, and then it's going to slam down tomorrow. So if you have any euro trade on, you probably want to close them out at some point. Meaning whenever this volatility ends, and it's not now, it's not yet. But by the end of the day, if it's up at 109, 109, 60, 50, sorry, I'm only saying. Yeah, that's classic. That's classic. That's why. That's why I suck at trading NFP. Sorry, NFP for that matter, but also FOMC. Wow. Who would have thought that today? Okay. Okay, fair enough. Okay, let's talk, people. Let's be serious. Okay. We are serious here. We have 10 minutes until Fed is over. What's the next trade plan here? The trade plan is to oi. You see this 14th of November thing where you have one day, 2, 4, 5, 6, 7, 8, 9 hours, a couple of days of volatility. You had 22 hours higher, and then you had, I'm not gonna say it's gonna happen this time around, but you then have one day or the double amount of time going lower before it found some kind of weekly. Is it a weekly even? A weekly M2 or some sorts, daily M2 or some sorts. So that's the other side to my trading, is I need to wait for a pullback. So right now we are currently here, and you can say you can buy the high. Sure, Sherlock. You do you. I'm not gonna follow you on that suit. But I am planning out that that day is today. So If we go up today, then we're going to be 1 day elevated, 1 day pullback, and then we can look for the continuation. The reason for that is we don't have much punch left in the market. That's all. Unbelievable, huh? Yeah. So right now, are you gonna buy this one at 61.90 at a higher high? Are you gonna take it here, scalp it a bit higher, or wait for the pullback later? Do you think gold is going to go high now, or as the moment is a pullback, will it continue down again? This is, in my opinion, only, not financial wise whatsoever. Don't take it to the bank as I haven't said this, but I think this is now the move higher. This isn't just a flinch. The problem with that, sir, is you have heavy resistance going higher. So how long are you going to go higher? I don't know. Target on this one is very difficult. But looking for buys on it, absolutely 100% able to. Able to. All right. Anyone that is going to hit the like button if you guys enjoy it. I haven't told you any jokes today. And apparently, when I'm on Twitter, Nick, I sound like Bert from Simpsons. It's a show of what do you call it? Of yeah, whatever those people are called nowadays. Oh, what are they called? South Park. Anywho, I'm a clown. So here we are clowning. Oil is going higher. I don't know why of that. I saw a report today of the market has gone from being squeezed to now being oversupplied by 500,000 barrels per day. That's why it's falling, apparently. So just wait until OPEC, in my opinion, just wait until OPEC says they're going to start cutting again. I think it's pretty easy, straightforward, to be honest. Easy peasy. Wee. 130 pips move on dollar yen. That's free money, bro. Wee. Look at that. Look at that 75 move. And Australian dollar, Japanese yen hasn't moved a thing. USD CAD finally broke lower. The easy peasy lemon squeezy trade is to come back up again and then sell on Monday. The only question is it going to be much lower before we do that? Pound dollar coming up to resistance. New Zealand dollar going up to resistance. Now, for all those support and resistance traders, if you believe this is going to be the peak, you're wrong. Support and resistance is just temporarily. If you think it's never going to break, it's always going to break. That's just Murphy's law. A big order got triggered and caused the wick. We go up now. Yeah, also people have positioned themselves for this meeting, I would argue. Like everyone knows that this is the starting point for and the rate cuts to come. Now it's the money to be made. If you open that position today or open that position tomorrow, or open that position on Monday, it's a completely different thing. I am personally not profitable on gold. Hi, Vesex. Gold silver ratio is getting a move on it too. Yeah. Yeah, that's kind of like trading a grandma for a grandma. They are both heavily manipulated, um, and I understand that it's moving. That correlation is something to look into. But in my world, is which twin do you take? They have the same drivers. And it's the same thing as trading dollar yen, to be honest, as well. It's which sister do you take? Do you like the blonde one or do you like the brown one? Or do you like the brunette one? It's equally the same. They both are female. They both have emotions. They both have needs. The only difference is who do you. Yeah, it doesn't make much sense to me. So when you trade gold or silver, in my books, you do it for the same reason. Gold is more volatile, but you trade it for hedging. Jesus, you're very much welcome. Yeah, I always try to keep you, but it does pivot point levels work on gold? Yes, 100%. Is it difficult to know which one's going to be in advance? Absolutely, 100%. Is gold moved by pivot points? Not really. Does gold come to logical levels and falls down? Absolutely. Is that more the norm than the? Is that the norm? Well, it depends on the time frame, right? Because if you look at monthly, we reached target this month and it fell down. We went down to center pivot and a bit lower. That's perfectly normal. Last month we came down to center pivot and it went up. Okay. Last month before that went up a bit lower, down to stop loss. Then it went to R2, and then we paused down to center pivot. So it does respect the levels it should respect. But I haven't found it to be profitable. I haven't found it to be my sole mission to make gold profitable for me. It's not necessary. It's too much frustration. It's not worth my blood pressure. Let's see. Take off the sound. Stop screen. Percent. Stop video. Share screen. Whole screen. Share sound. Let's see. All right. Good luck on the reversal on dollar, if it happens. Everyone is waiting patiently for the one and only Jerome Powell. You are late to your own party, sir. Yeah, I need to find which asset should we have on the side here. By the way, in the meantime, your dollar. All right, all rise.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%.
Don't shake the camera.
And to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Still data dependent. There's a hawkish statement there, but overall.
Thank you, Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
Good question.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, microphone, sorry. Steve Leisman, CNBC.
Fantastic.
Chairman.
Oh, shut up. Fantastic. That's what I wanted to see. We are near at the high, Steve Leisman.
Interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, People generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Dollar falling through
Nature of that discussion today. Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast. So many people mentioned what their rate forecast was. And there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. And a preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Rachel? Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility.
I said S&P to 4,700 earlier.
So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think
Good question.
Forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters, a very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus or a little more than that growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen, strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year. Whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
That was Powell giving a big finger to the to the market and the projectors
in the economy. And I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down they basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor. And it's certainly it's a part of how we think about things, but really it's broader financial conditions that matter. And as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy.
Why wouldn't Fed listen to politics? It's too volatile. It's nonsense. It doesn't matter. What matters is, what do they do about their fiscal policy? What do they do about their taxes? As of general, if it's Trump, if it's Biden, whoever, it doesn't really matter. I don't care about politics. We don't need to care about politics because it doesn't matter in as much in Forex, in much in currency trading, in much in commodity trading, as much as the monetary policy of the independently politically Fed, at least supposed to be, at least.
We have in place, and that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully. So as time goes forward.
Tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals. And that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth. And, I'm just focused on what's the right thing for us to do. And my colleagues are focused on that, too.
The markets seem to think inflation is coming down incredibly.
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, if we make decisions about policy changes going forward, we're going to look at all those things, and particularly as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Good, Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance.
He has already said that, you bloody idiot of a journalist. Can't you just ask better questions? He's already said it's a tight one.
Job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation.
Shocker.
The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest that it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, then when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
What was the question?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of
improve the mood of people, but we do see.
Yeah, then when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
Low, the high things gradually, I would say, rate is all.
Claire. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, then when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
If the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
that's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And
in radio, Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand. And what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median participant wrote down 1.4% growth, but we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, this, but allow me to say it again. We don't debate or discuss what the right, whose SEP is right. We just say what they are and we tabulate them and publish them. So it's, it's important for people to know that, but it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and doesn't need the tight policy. It depends on the economy can evolve in many different ways, right? So
I like Powell.
But it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina. Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
It's yesterday.
How are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment. Someone once said that the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Go to Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July.
That's a funny comment.
2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restriction.
Altaf, I never missed a train. I have certain criteria I do. There is days where we have 100% pullback on the news. I can't be buying 61.50 with a 50 pip stop loss when there's a 50 pip drop, and I should buy that instead of well, it went higher, fair enough, whatever. I have every day going forward now to buy it on the pullback. If I just get a bit less, fair enough.
restrictive policy is weighing on economic activity. It takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
3% would be reasonable.
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
He would never comment on a specific number, people. Come on. Better questions.
Hi, Chair Powell. Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation?
Why has inflation come down so quickly? Because big corporates has increased the prices ridiculously a lot, so people don't have enough money to anything else. That's why.
Or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think this, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there was something different about the U.S. economy.
Yeah, so it's not that it may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And, we had the view, my colleagues and I broadly had the view that we could get a lot of, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced. And, something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run, we definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it gets down to demand and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down. The labor market keeps getting back into balance. And, it's so far so good, although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or as a result or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out. And at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking though the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight.
She's clever.
And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time. Thanks very much.
I like her. All right. Some click clap for Mr. Powell. All right. That was a fun day. I'm just going to say what I said earlier in chat. One as well. Is that price has reached 109, 108.8. I would say that's pretty much the peak on the euro dollar. Doesn't need to be. Can of course go higher if that matter. But we have ECB tomorrow and so forth. I am looking for a pullback on Australian dollar, US dollar. I am not getting that so far. New Zealand as well come up to 62.10. There is a couple of questions going forward. Is when are we going to continue? How deep are these pullbacks going to be? It's a bit of a no man's land for me at the moment. I will do a lot of research and I'll come back to you guys tomorrow of are we going to expect a new higher high above 62.20, or are we going back down to 65.50, 61.50 before looking for another buy? Indexes are overbought. What generally tends to happen after FOMC is we are generally tending to fall. We definitely went up to 4,700, as I previously said before the meeting. You're welcome. Dollar yen had a bit of a fall earlier and has fallen further. It has now fallen 200 pips this evening. After FOMC. Beautiful trade setup. I didn't take it because I don't trade it. But other than that, great. Great. This could have, of course, gone opposites. Euro yen fallen a bit, pound yen fallen a bit, CAD yen fallen a bit, Australian dollar fallen a bit, and New Zealand dollar, Japanese yen fallen a bit. I am still going to stick to my dollar bearish outlook. We have now seen a bit more falling. Where I supposed to should I have sold when he came out and speak? I can do that. I should do that, but it's a bit of a hit and miss. It can go all the way back up again to entry at the start of the move. So it's kind of like, in the middle there. So first of all, Powell acknowledged that we have that policy is tight, that it has the desired effect on the economy. He has said that they're not going to alter QT. He says that this might be the peak of this. We are at the high, or we are at the high of the interest rates. They're seeing strong growth appears to be moderate. Inflation is making progress, meaning it is falling or going the way they want it to be. They estimate core PCE, which is core personal expenditure, to be 3.1 in 12 months. All of their forecasts has been revised down, which is a dollar bearish move. And they are seeing that activity in housing sector has flattened out. I have seen multiple reports about the closing down, but things is going really a lot much worse. Other than that, it has been what has happened is what was I wanted. I couldn't have asked for a better outcome, to be honest. Both in terms of the dollar weakness, in terms of what Powell has said, and in terms of everything that was necessary to be done. So, hello, sir. Do you think that the 4 to 5 rate cuts that were priced in next year needs to be priced out? It is already priced out. No, sorry, it's already priced in. No, it will not be priced out. It will still stay, and still dollar will continue to fall. So don't make the adjustment and start buying dollar now. Of course you can, but it's going to be a large uphill. I think dollar bullishness is going to come later. May not now, but of course we have pullbacks from dollar. It's not going to be a straight up thing, but a straight down thing. Sorry, but don't be foolish. So it will still depending on the outlook on the inflation coming up next month. So until then, we're going to stay dollar bearish. We saw a great demand at 107.50. We went up to 108.84. My name is Ivan. I was your host today. I tried MKKM. Market went too fast for me. So I tried my best on Aussie. Then it didn't come back to my pullback. So where is it? Where was it? I wanted to buy around 61.40 and 66. Didn't happen. So my live trading was live, but not good enough. So we'll just have to wait for tomorrow. All right. See you. Have a great night. Boom. I'll see you guys tomorrow.